Looking to make money in the stock market? You're in the right place. In this video, I've carefully compiled everything you need to start earning real profits. No unnecessary details, no confusing information, just clear, actionable strategies that work. If your goal is to make money trading, this video and the other content on this channel will give you everything you need. Nothing more, nothing less. Just what you need to succeed and start making money. The stock prices of publicly traded companies are shaped not only by market conditions, but also by financial indicators in their financial statements. The cash and cash equivalents item in the balance sheet is a critical indicator that shows the company's liquidity status and its ability to meet short-term liabilities. A decline in this item, which includes cash, short-term deposits, and liquid financial instruments, can sometimes be interpreted as a sign of weakened financial health, negatively affecting stock prices. A decline in a cash and cash equivalents item often signals weaknesses in the company's operational performance. For instance, if a company's revenue decreases or operating expenses cannot be controlled, the amount of cash flowing into the company declines. Such a reduction is perceived by investors as a sign that the company's growth potential is weakening, leading to downward pressure on stock prices. Declining sales indicate reduced demand for the company's products or services, while rising costs negatively impact profitability. These adverse operational indicators erode investor confidence, resulting in a decrease in market value. Allocating a significant portion of cash reserves to debt repayments can indicate that the company's financial structure is heavily dependent on debt and that it faces liquidity risks. As cash reserves rapidly decrease due to high debt repayments, the company's ability to finance investments is also restricted. This situation can lead to sharp declines in stock prices, especially for companies with limited cash generation capacity. During periods of heavy debt repayment, investors closely monitor the company's financial structure. If cash flow weaknesses are observed during this period, it is often interpreted as a threat to the company's financial stability and is negatively received by the market. Using cash reserves for investment activities is usually seen as part of a growth strategy and is positively received by investors. However, if investments are unplanned or ineffective, they can harm shareholder value. For example, if a company's capital expenditures yield low returns or are strategically misguided, this creates the perception that financial resources are being wasted. Investors may view this situation as a risk, creating downward pressure on stock prices. Some companies use their cash reserves for share buybacks or dividend payments. While these practices may appear attractive to shareholders in the short term, they can limit the company's long-term growth opportunities. If cash reserves are entirely allocated to shareholder payments, it creates the perception that the company will lack sufficient resources for future investments and operational activities. This is often interpreted as a negative signal, particularly for companies in growth-oriented sectors. A company's failure in cash management is often perceived by the market as a sign of incompetence on the part of the management team. Unnecessary expenses, liquidity crises, or inefficient use of cash reserves can severely damage investor confidence. In such cases, rapid declines in a company's stock prices are inevitable. When analyzing changes in a cash and cash equivalents item, investors should focus not just on the numbers, but also on the reasons behind them. Reviewing the cash flow statement can clarify which activities are causing cash outflows. Operational outflows might indicate weaknesses, while investment-related reductions could suggest growth-focused spending. Comparing the company's cash management practices with those of its sector and competitors offers further context, helping investors gain a clearer understanding of its financial health and performance. Changes in the cash and cash equivalents item provide critical insights into a company's financial health and operational efficiency. However, the impact of these changes on stock prices largely depends on their causes and how investors perceive them. Factors such as operational weaknesses, debt repayments, unplanned investments, and poor cash management typically stand out as contributors to stock price declines. By carefully analyzing cash flow statements, conducting sectoral comparisons, and evaluating management strategies, investors can make more informed decisions and better assess the risks and opportunities associated with these changes.